Given the bleak assessment of the banking system balance sheets and the large stock market run-up since last March, what advice would you give the average investor right now?
Well, here's the thing. Everybody is screaming about the 50% rally we've had off the lows, okay? And it's been an absolutely insane rally. You look at the price-earnings ratio on the S&P 500, as of September, 132 on actual reported earnings. Okay, it's never been there before. The highest it ever got was right at the height of when things started to blow up during the dot-com days. It got up to 60. All right, it's double that. So, there's no argument to be made that the valuations support the prices. But what you keep hearing is, buy now or be priced out forever. Well, where have we heard this before? Didn't we hear this back in 2005 with real estate? All right, you have to look at where is the downside risk and where is the upside risk. And this is the basic philosophy that I always follow for my long-term account, money that I cannot afford to lose. If I think the market potentially has 10% upside in it over the next 12 months, but there's a risk of a 30% drawdown, I could lose a third, I'm an idiot to be involved. Okay? Because just as an example, if you lose 50% of your money, and a lot of people did during the crash, 2008 and early 2009, you lost half your money, you need to double to get it back. People don't understand that. They think, 50% rally, that's great. Well, no, it's not. You're still down 30 to 40%. The Dow's at 10,000, is at 14,000 in October 2007. So, if we've seen this rally until you see the economic picture improve substantially and you see top-line numbers come in and start to increase, I think you have to be very defensive here. I don't see anything that makes any sense at these levels in terms of price-earnings ratios. So you take a look at Amazon, for example, selling at 60-sometimes PE. I can't justify a 60 PE for a stock that has a 4% gross operating margin. And yet it does. Okay? It has an operating margin that looks like a grocery store. That's the closest comparison I can get in the brick and mortar world. And yet people are willing to pay $120 a share for it. I'm not, but there are people out there that are. I can't justify that. I mean, if you're aggressive, can you short a market like this? Sure, but you have to be willing to accept a lot of risk. The person who has their money in a 401k and cannot afford to lose it, what's wrong with sitting in something that is absolutely safe? What's wrong with, if you're under $250,000 being in a CD? Yeah, it doesn't earn anything, but you don't lose anything. What's wrong with being in Treasury Direct in the short end of the yield curve where there's no interest rate risk? Wait for things to rationalize. If the economy truly improves, then you can be involved in a true bull market. There's nothing wrong with that. From 2003 to 2007, I was fully invested. And, that was a perfectly appropriate thing to do given the macroeconomic outlook. It's not here.
For those in our audience concerned about a deflationary spiral or an inflationary spike, how would you suggest they position their portfolio?
Well, here's the question you have to ask yourself. Inflation defined by who? Okay? Because this is, people have, for example, they tried to use tips as a hedge against this. The problem with that is, look at what's happened, for example, to food prices. Okay, look at what has happened to fuel and energy prices over the last 2 or 3 years. There hasn't been any kind of deflationary pressure there. Certainly, if you want to buy houses, they're a heck of a lot cheaper than they were 3 years ago. But in terms of absolute necessities, things you must buy. How about healthcare? Okay, there's another example. Costs are going up 20% a year. There's the inflationary pressures are showing up in places where you really can't stay ahead of them. And in terms of trying to find yield, reaching for yield is how people got into trouble in the first place. My hideout during the 2000 to 2003 crash was in municipal bonds because they paid a competitive coupon and they're federal tax free. Unfortunately, you can't go there now because, if anything, the states are in more trouble than the federal government is. So where do you can't go into the municipal market, which normally would be a great place to hide in a circumstance like this. And if you were crazy enough to go into the closed-end funds, like IQI, you've gotten absolutely slaughtered over the last year. And so I look at these things and say, where do you hide? And the answer is there really isn't a safe option. If you believe in a hyperinflationary scenario, if you think that that's a likely outcome, then I would, as an insurance policy, if I believed that that there was at least a 50% chance of that, what I would probably do is buy far out of the money leap calls on gold, on the GDX, which is the Gold Miners Index, and on either the S&P 500 or the Dow. And I'd put about 5% of my capital into that, out as far as I could get, which normally in the leaps market is about 2 years. All right, and the reason behind that is if you have hyperinflation, if we get a really serious inflationary bout, not 5% a year type stuff, we start seeing a 20, 50% a year type of inflation. You need leverage in order to stay ahead of that. If you buy gold, at best, it's going to keep up with that, and then you're going to have to pay collector's tax on the gold, okay? And the taxes are going to destroy you because what's going to happen in this situation? Taxes are going to go up. So now you have a 39.6. Well, hey, listen, back in the 1960s, 1970s, there was a 90% marginal tax rate. What makes you think it can't happen again? All right? You make all this money with the correct bet, and then the government steals 90% of your profits. So you have to be very careful here because something that just keeps up with inflation isn't good enough. If you really think that that's going to happen, you need leverage. But you have to do it with a defined risk bet because otherwise, if you're wrong, you're going to get killed. I don't think it's a high probability scenario, but I have said several times that if that was the direction that I believed things were going to go, then the play would be to buy far out of the money calls, leaps as far out as you can go, put about 5% of your portfolio into it, and be willing to write it off. It's an insurance policy. You buy insurance on your house in case there's a fire. If there's a fire, the money you gave the insurance company is gone. It disappears. And that's essentially what you're buying insurance against, is the possibility of that sort of a destruction of the dollar, basically. On the other hand, the other side of this is that if we get a massive debt liquidation system set up and we get a credit freeze, you're going to get massive deflation. And in that case, what you want to hold is actual money because you will be able to buy hard assets, land, machinery, things like this, for literal pennies on the dollar. And that opportunity will come, but it will only come if you have cash because there will be no credit available for you to use at all. As a result, you need to be immediately liquid. Okay, so if you want to cover both scenarios and you don't believe that the everything's going to be okay and peachy keen kind of thing is going to happen regardless, that we're going to get one of the two disasters, okay, then you take the 5% of your capital, you put it into the inflation is going to ruin us bet, and you put the rest of your capital somewhere where it's safe and is cash. And you sit and you wait, and you see which way it plays out. That, I think, is the most balanced approach right now.